Okay, hi. So we're just continuing our discussion about the pension plans, which are the employer pension plans. So under the employer pension plans, we said that you can have a defined benefit plan, you can have a defined contribution plan, you could have an IPP or a PRPP, and the other ones which is possible is a deferred profit sharing plan, where the employer contributes only when it has a profit. So it's not mandatory for the employer to put money into a DPSP. They will only do so when they have a profit. And the plan members, they decide on the investments. So it's not locked in. You can always take money out from it. You can get a lump sum, or you can put it into annuity, or you can transfer it to RSP or to a RIF account. And there's no employee contributions to the deferred sharing plan. It's only by the employer. The investment is tax sheltered until it is withdrawn, and then you do pay taxes on it when you take the money out. And then the other one is the group RSP. So these, both the DPSP and the group RSPs, you don't have to put money into it. And so this is same as a regular RSP. You can get home builder plan, lifelong learning plan. We'll talk about those shortly in the next slides. And the plan is not locked in. You can transfer the money to the member's RSP or the member's RIF account. And it can also be annuity. You can, so when it matures, when the RSP matures, you can transfer it to a RIF account, which gives you a pension, or an annuity, which gives you a pension, or you can take it in cash. So those are the options there. So those were the employer pension plans. The second ones that we're talking about, we talked about the government ones also. And now we'll talk about the individual plan, which is the RSP, Registered Retirement Savings Plan. There is a limit on how much money you can put into an RSP. And the math for it is simply, this is based on your income. So we have to see what is the earned income for the person. Let's suppose the person's salary is $80,000 and they get a bonus of $14,000. And they have rental property, which is rental income from property, which is $16,000, of which they had to spend $8,000 for that property, paying the interest and the other expenses for that property, maintenance, etc. And let's suppose they get dividend income, $3,000 from investments, and they had to pay spousal support to their spouse, to their ex, $12,000 in that year also. And they were a member of an RPP pension plan. They had contributed $10,400 to a pension plan also. Now, we will use the salary. Salary will be used in the calculation for RSP room. We will use the bonus also. For the rental, we have to take the net amount. So 16,000 minus 8,000, of course, we will use 8,000 as the net amount. We're not going to use dividend income. Any investment income, actually, capital gain, interest, or dividend, we will not use that in the RSP calculation. We will minus spousal support payments. So any payment going out to the spouse are minus. If they are receiving pension, receiving any spousal support, we will add that for the math. So we take 80,000, we said, and we're going to add the 14,000, and we will take the 16,000 and we'll minus the 8,000. And we will not take the dividend, and we'll minus the 12,000 also. When you add that on your calculator, you will get $90,000. Now, this is your initial calculation of earned income, and we take 18% of that. When you calculate it, it'll be $16,200 will be the earned income. Now from here, we have to minus the pension adjustment. This amount here is the pension adjustment. And we are going to minus that because this person has a pension plan and they're entitled to a pension from the company. So we will minus that from here. So 16,200 minus the 10,400. So like we mentioned, because if they belong to defined pension plan, the pension adjustment is going to be, let's suppose, 10,400. That is minused. So we're left with now 5,800, but we're not done there. This is the, let's suppose there's 5,800 is the unused RSP room. So this is the 5,800 is the amount that they can contribute to the RSP. If they do not contribute, it becomes unused RSP room and is carried forward. So they can either put it into the spousal RSP, which is for the spouse, or they can contribute to their own RSP. It's up to them. If they contribute to the RSP of the spouse, and the spouse has, let's suppose she earns $8,000 annually. So that means that the savings is going to be about $1,440 when they take out the money for her, for the spousal RSP. So $2,000 is suppose also the over limit. You're allowed to put in up to $2,000 over the limit into an RSP. So instead of 5,800, we can add the 2,000 to it. And so 7,800 is the limit for this person, how much they can put into RSP. And if they put over that limit, there's a 1% penalty per month on this amount, which they put over the limit. And based on this now, we have an idea about how much this person can contribute. And as we said, they can contribute to their own or to a spousal RSP. Okay, next we're going to talk about in RSP, what are the benefits? So when you contribute, like we said, you get a tax deduction, meaning you get an immediate tax saving that year. You may get a bigger tax refund, more money back from the government. So that is one benefit, that you take your earned income, 18% of that, and then minus the pension adjustment, that will give you your amount. In like 2018, the maximum you can put in is $26,000. If your income is very high, you calculate 18%. If you go over the 26,230, then that's the maximum you can put in. So you must know the 18% for the exam. That is important. In the RSP, you can take out money anytime. It's not locked in. There will be withholding taxes advance that you will end up paying. So if you do take it out, if you take out up to 5,000, it's 10% will be the withholding tax, which is a prepayment by the investment company to the government. If you take out between 5 to 15,000, it's 20%, and more than that will be more than 15,000 will be 30%. So withholding tax is an advanced tax that is paid to the government, and then when you do your taxes next year, then you can either get a tax refund or you have to pay more taxes based on this. So you can do when you have money in the RSP, you can use it for home buyer's plan or lifelong learning plan. If you take out money based on those two plans, there's no tax when the funds are withdrawn. So we'll talk about that in a little more detail. In the RSP, you can invest into many different types of investments. You can put in stocks, in bonds, mutual fund, segregated funds. You can keep it into like a savings account. You can put it into GIC. You can invest in derivatives. So a lot of different things are allowed in RSP. These are eligible RSP investments. The exceptions are you cannot put real estate in an RSP or any other put options, etc. So these investments are same as, so when you convert your RSP to a RIF account, or you have a pension plan and it converts to a RIF account, these are all registered accounts. So in the registered accounts, you can put any of those items there. You can also put gold currency in the form of currency, gold certificates also. So the benefit of RSP is you put money in, you contributed for when you're starting to contribute, you're 25, 35, 40, 50. For many years, you're putting the money in. This grows tax-free. You don't pay any taxes on the growth in your RSP. Every year, it will grow tax deferred. Tax deferred means you do pay taxes when you take the money out in retirement. So you have to mature your RSP no later than December 31st of age 71. Most people are going to retire at age 65. After age 65, you can convert your RSP into your RIF account, or you can take out the money all as cash. If you do that, it will be taxed. So it's not a good idea to take out all the money all at once. The good idea is to put it into a RIF account. It's a similar type of investment plan, but you do need to take out a minimum payment every year from the RIF account. You cannot contribute any more to the RIF account. So usually age 65 you'll do it, but age 71 you must. Or you could put the RSP on maturity into an annuity. And with annuity, we mean that here, like you remember, we went through annuities in the annuity chapter. This is, you can get a guaranteed income and there's no more investment in it. The income is fully taxed because the money is all coming from RSP. This money, you never pay taxes on it. So money from annuity, money from lump sum or RIF account, it will be taxed. So that is the benefit of the RSP. So I'm going to pause there and then we will continue our discussion in the next. Have an excellent day.